Welcome to this final explainer. We've walked through 29 modules of knowledge together, and today we're synthesizing all of that into your practical, actionable investing blueprint. Think of me as your mentor, your older brother in this space, here to guide your financial journey. We are going to connect the dots between your daily habits, your decades-long wealth horizons, and the realities of Indian tax planning that cause 90% of retail investors to unnecessarily lose 20 to 30% of their returns.
Okay, let's dive into this master whiteboard session. Here's our roadmap. We're going to cover the 7 fundamental principles, break down Indian tax rules, explore tax efficiency strategies, set up your routines and watch lists, map out a 20-year wealth plan, and finally lock in some final commitments. Let's get to it.
All right, Section 1, the 7 fundamental investing principles.
We're distilling nearly 9 hours of knowledge down to 7 core truths. Here's your foundational checklist. Number 1, stocks are business ownership. You aren't just trading 3-letter tickers blinking on a screen. You're buying into living, breathing companies. 2, quality absolutely beats cheapness. A wonderful business like Asian Paints or HDFC Bank at a fair price, that's a true wealth compounder. 3, cash is greater than profit. 4, always, and I mean always, use a margin of safety. Buy below intrinsic value to cushion those inevitable mistakes. 5, long-term holding compounds wealth. Patience often beats raw skill. 6, emotional discipline absolutely crushes IQ when markets panic. And 7, avoid solvency and governance disasters. Seriously, dodging a single disaster, like a company drowning in debt, is just as crucial as finding that next massive winner.
And to hammer home that third principle, there's this brilliant reminder from Warren Buffett. Cash is a fact, profit is an opinion. You've got to watch the free cash flow. Accounting profits? Well, those can be legally tweaked with clever depreciation schedules. But cash sitting in the bank? You literally can't fake that. It's either there or it isn't. So if you see operating cash flow drastically diverging from reported profit, that is your ultimate warning sign.
Moving right along to Section 2, Indian Tax Rules Explained.
Now that our foundation is rock solid, we need to talk about the environment we're operating in. What if I told you that you could instantly save 7.5% of your gains simply by waiting? It's true. If you sell an asset before 12 months, boom, you get hit with a 20% short-term capital gains tax. But if you just hold for over a year, that burden drops to a 12.5% long-term tax rate. You're instantly keeping way more of your own money just by letting the calendar turn.
And listen, this specific number is about to become your absolute best friend. 1.25 lakh rupees. That is the exact amount of long-term capital gains you can book entirely tax-free every single year under the new Indian tax rules. So, if you make 3 lakhs in long-term gains, you're only taxed on 1.75 lakhs. This is a massive structural advantage if you use it smartly year after year.
When you compare different asset classes, the math is just glaringly obvious. Futures and options, along with dividends, are taxed at your personal slab rate. That can easily hit 30%. Plus, F&O is treated as business income, which brings a triple whammy: high slab rates, severe audit compliance costs, and the grim reality that over 90% of retail traders lose money. Compare that miserable uphill battle to a clean 12.5% rate for long-term equity holding. The math undeniably favors playing the long game.
Okay, Section 3, Strategies for Tax Efficiency. Knowing the rules is great, but how do we legally and efficiently keep more of our wealth? Enter tax loss harvesting. It's a simple 4-step strategy to wipe away a chunk of that 12.5% burden. Let's walk through it. Imagine you have 2 lakh rupees in gains and 50,000 in losses. Steps 1 and 2, you sell the losing stock to officially book that 50,000 rupee loss. Step 3, you set it off against your gains, so your total taxable gain drops to 1.5 lakhs. Since that first 1.25 is totally exempt, you're only paying tax on 25,000 rupees. Think about those savings. Then, step 4. If you still genuinely believe in the business you sold, you just wait 30 days to avoid any wash sale headaches, and you buy it right back.
Next up, Section 4, building your investing routine.
With the tax math sorted, we need to set up the operational mechanics. And let me tell you, you do not need to be glued to a monitor to build wealth. A structured daily, weekly, and monthly timeline proves it. Daily, spend just 5 to 10 minutes glancing at the news for your holdings, absolutely no obsessive price checking allowed. Weekly, take 30 to 60 minutes to read quality financial articles. Monthly, carve out 2 to 4 hours for quarterly results. Quarterly, spend a weekend afternoon doing a deep review. And yearly, Dedicate maybe 8 to 16 hours to reading annual reports and executing your tax plan. It's a highly manageable routine that totally frees you from market anxiety.
It's amazing how quickly we can filter out the noise. You start with a massive universe of over 100 companies, like the Nifty 50 and Next 50. Then, you ruthlessly apply a strict quality filter. We're talking return on equity over 15% and a debt-to-equity ratio under 1. Suddenly, you're left with maybe 40 names. From there, pick your absolute favorites. A high-conviction watch list of just 30 targets that you deeply, intimately understand. Then, you just track them and you wait. You only strike when both the business quality and the stock price are perfectly aligned.
Now, every legendary investor, from Buffett to Pabrai, uses an investment journal. It's absolutely crucial. Recording the exact date, price, your why, expectations, and confidence level forces clear thinking. If you write down that your confidence is an 8 out of 10 specifically because of a company's robust free cash flow, and then the stock drops 20%, but that cash flow is still strong, your journal literally reminds you not to panic. It is your psychological anchor in a sea of volatility.
All right, Section 5, the 20-year wealth plan. We've got the routines and the tools. So let's zoom way out. What does this discipline actually build over a couple of decades? This is the roadmap of your life as an investor. Years 1 through 3 are all about foundation and learning. You're saving heavily, keeping the actual portfolio small. By years 4 to 7, your confidence builds. Years 8 to 12, that's the compounding phase, where you're holding quality stocks tightly and seeing exponential growth. And finally, years 13 to 20, the wealth phase, that beautiful moment where your portfolio consistently out-earns your annual salary.
The math here is just staggering. If you invest 50,000 rupees a month at a 15% compound annual growth rate, you hit roughly 7.6 crores by year 20. But check out the math on those later years. Can you imagine your wealth literally doubling between year 25 and year 30? That is a massive jump from 15 crores to 30 crores, achieved entirely through the sheer power of compounding. The heavy lifting in those later decades is done completely by time, not your wallet.
Finally, Section 6, Final Wisdom and Commitments.
As we close out this explainer, I want to leave you with some timeless mentorship. Warren Buffett said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Never, ever forget this rule. Attempting to buy cheap, low-quality businesses is the absolute fastest way to completely derail a 20-year wealth plan. Time is the greatest friend of the wonderful business and the ultimate enemy of the mediocre one. So here are our 7 commitments to ourselves, the fraternity rules that'll protect your psychology when the market inevitably tests you. 1. Keep reading constantly. 2. Keep writing in that investment journal. 3 and 4. Guard your patience and discipline fiercely. 5. Drop your arrogance by honestly reviewing your mistakes. 6. Think independently of the panicking crowd. And 7. Always maintain a 10+ year focus.
The knowledge is yours. We've covered the fundamental principles, the critical Indian tax rules, and the exact daily routines required to build generational wealth. The blueprint is fully drawn and in your hands. So I'll leave you with this. Now that you have the literal map to 20 years of compounding wealth, what are you going to do tomorrow morning to take that first step?